Welcome back. Let's have a look at these past picks. We'll start off with Manulife. Now, we should remember that David was on June 4th of last year, and the market, the TSX, is down just over 3%, including dividends since then. So Manulife, you got out of this one, did you?
So as a tactical investor, one of the three key tools that Barometer uses is stop losses on all of our positions. And as people may recall, June, July, August of last year was a very difficult 3 months in the market. And all three, I think, of the top picks today wound up hitting stop losses in June or July of last year. So if I look at it today, Manulife, would I buy it? The insurance group is showing some strength. I would prefer Sun Life, but both, I think, perform quite well going forward.
Okay, so you would consider rebuying?
I'd re-put on these positions. We're quite positive market-wise. We like the insurance sector, and Manulife is executing.
Citigroup down around 15%.
Yep. Citigroup, we like the banking sector. We largely were out of financials through the early part of last year, I guess the early part of last summer. JP Morgan and Bank of America might be a little bit more attractive because they're less globally focused than Citigroup. But again, this group I think looks quite attractive right now.
The U.S. banks and Citigroup. What would distinguish Citigroup from the other big U.S. banks for you?
Well, if you want global exposure, Citigroup has a big global presence. If you would prefer to focus on the U.S. domestic economy, Bank of America would be more attractive, both for their commercial banking and for their mortgage business. So it depends on what you're looking for. We think really going forward, we're in a developed market. Equity market, and so we'd prefer to focus on the U.S. domestic economy.
And then finally, FedEx. The cliche is it's a classic economic indicator.
It is, and certainly the transports started the correction last spring. They were one of the two groups, industrials and transports, that started the market's correction. Having said that, FedEx bottomed in February at 120. It's trading $165. It looks quite attractive, and frankly, the logistics companies are the first to do well as economic activity picks up. So don't own it currently, but I would have no problem owning the stock.
It's funny, SocGen is out with a report saying that around the world, companies are having trouble growing their revenue. And not just profit, but revenue. Because, of course, some countries are wrestling with deflation. So that can't be good for FedEx.
Well, that has been a problem. Having said that, any small pickup in economic activity impacts companies like FedEx and UPS almost right away because they have to get stuff to market quickly. So while the rails maybe look a little less attractive and the truckers look a little bit less attractive, I think that the logistics companies like FedEx and UPS look a little bit better.
Okay, we have to take a break. We are going to be back with David Burrows of Barometer Capital Management. He's answering your questions on North American large caps. The number, 1-855-326-6266.